let's take a look at another example. We did this earlier. This is the sterling yen. You are looking here at, this is the 4-hour chart. We have, of course, momentum that is below overbought, but above zero. So it's a positive momentum plot on the 4 hours. On the 1 hour, it's also a positive momentum plot. So this is a trending market. It becomes a cycle 3. Anything, you should be implementing the same strategy, and that is what would happen if you are implementing the same strategy. And identifying, all right, identifying the corrective cycle parameters. Over here, we're showing each day. Each of these arrows in brown, yellow are marking 1 day. So these are the corrective cycle parameters. Okay, so they look pretty much the same. We always waste a lot of time doing the internal corrective cycle projections, but in reality, it shows here that all of these internal cycles actually bounce at oversold levels. None of them is a degree 5. They will all bounce at internal pivot levels, so long as you're having positive momentum on the 1 hour. Only this one becomes a bit extended. Also, in reality, you can label them into higher degree 2, higher degree 4, higher degree 2, higher degree 4. You understand now this is a higher degree, right? That you already had a 2 here and a 4, and this is a higher degree A. Okay, just by simple count labels, you would understand that yes, it does show like it's big higher degree A, and that is the end of the market. Without doing now too much analysis and too much extensions and too much corrective projections, just because of the fact that we're having the cycle 3, we know that the identity of any corrective cycle will recur because it's an internal local corrective cycle. It will just a 3-wave swing, most probably, so it's very internal, very local, and that every day, simply by buying S1 and taking profits at R1, you're doing the same projections that we were showing on that money management matrix that we were showing for the sterling dollar. So every day here we're showing we bought S1, take profit at R1, you bought S1, take profit at R1. At this point, you even could have taken profit at R2. You always buy S1, take profit the next day at R2. This is just a 15-minute chart. You buy S1, you take profit at R2. You buy S1, you take profit at R2, so long as the condition is set. So long as you're having dual positive momentum, and so long as you're able to identify and count the internal corrective structures. So the internal corrective structures always get contained above oversold, so long as you are having dual positive momentum cycles. The one time that it does break above, break below oversold, it means that the structure is finished. Sorry, has changed. Internal corrective structure is no longer a 3-wave swing, it is a 5-wave swing because it did an extension in wave 3 here. Don't even have to relate to what kind of extension happened, but there was an extension because the momentum dropped below oversold. This means, of course, this is higher degree 3. Everything falls back in place. You know that you have a 2 and a 4, higher degree 2, internal degree 2, 2 and a 4, internal degree 4, higher degree 8. We don't have to do it at the time when we're trading, but after you finish some of your, or after you have actually engaged in the trades, close them out, everything immediately stands out, and you know before time that the market has stopped, even before showing negative momentum on the 1 hour chart, just by identifying the corrective cycle inside of the trend. All right. It also shows where we can have hedges. So we were looking at hedging on that sterling dollar chart. Remember, we're always buying S1 and taking profit at R1, or we're buying the pivot and S1 and taking profit at R1 on a daily basis. Your hedges, of course, are always one support below entry. over here, if we relate this to our momentum structure, your hedges are really below a level 2. So you're having here 1 and a 2 and a 3. You want your hedges below that level 2, and you find this is where you hedge. Of course, you can take it a bit higher, but we don't want to be spiked. So long as you have a level 2 here, hedge runs here, even if the market goes here. So long as you have a level 2 lower, then of course the hedge that time is lower. And we have a level 2 and 4, so the hedge is higher than V2. We have here a level 2 and 4. We talked about this, but I don't want to complicate matters. So the hedge is below level 4. It's that simple. We go up into 5 and then we reverse. Again, I don't want to complicate matters. You are really very safe just leaving a hedge that is always 2 supports below your entry or 2 resistances above your entry if you're selling short. The important thing, the most important thing going forward now is to focus on money management.